Hi everyone, welcome back to Be Rich. I have Sashwath with me, and we're going to talk about what today, Sashwath?
Well, I was flipping through the newspaper, and a lot of quarter performances have come out for Q3, and I found some interesting tidbits to look at. And I also wanted to talk more about an article which would be published at the time this video is being published. So, open the Hindu up, and you'll be able to see my article. And this article talks about how PE ratios matter quite a bit, and of late, there have been a lot of fund managers and a lot of asset managers who've been touting that P ratios don't matter. Quality is what you need to care about. You shouldn't care about valuation as much. If you buy quality, valuations will follow, is what a lot of fund managers have been speaking about. But this piece basically goes against the grain and says that, you know what, I don't think so. Valuation is what really matters. And we'll be discussing more about that this video.
Correct.
So, yeah.
Anand even had spoken about it in his Tamil video, where he had emphasized and very eloquently explained when he saw the HDFC results and you saw the IndusInd Bank results, then you saw the South Indian Bank results, and how HDFC had done very well.
Yeah.
And the market was punishing HDFC, and South Indian Bank compared to HDFC hadn't done as well as HDFC, was being lifted by the market. It's just simple fact that you get more bang for your buck with the South Indian Bank compared to HDFC right now, and the market seems to be moving towards that direction, and it makes absolute sense. And we've been talking about this off camera, me and Shashwath, about how people are nowadays not paying prudent attention to earnings, where earnings has become like a joke. The general feeling in the market is whatever you put your money, it'll have earnings. It's not true. You can do a lot of things and have no earnings. For example, let's take the American market and look at some stock like Boeing. Before this whole fiasco of its flight door blowing open, if you take the Boeing stock price over a period of maybe 5 years, 10 years, it has been range bound between 200 to 300, maybe maximum $370. And if you had put money, depending on wherever on that graph, you would have hardly seen any great movement in it. This can happen with any company, where you like a lot of you keep asking, why can't I buy the diamond needle? Yes, you can buy the diamond needle, but over a 10-year period of time, you want your money to at least double, triple, quadruple. You want those multi-baggers, and multi-baggers only happen when there's opportunity for growth.
Yeah.
By buying a tree which is already borne its fruits and everything is over, yes, it might be a big tree, but there's no opportunity for you to get any fruits from the tree. So I can't emphasize how important it is to look at earnings and to see what Anand also said in the video, in the Paisa Bolte video, he's spoken about it, where he said you have to see not only earnings, but see what is the future prospect of that business for the next foreseeable future. Is there going to be growth? Is there a way forward for that business to continue growing the way it's been growing? And then you place your coins on it. If it's just going to be sustaining, at best, whatever it's doing, there's not going to be any growth in earnings. And that pegged against inflation and dollar becoming stronger, any global company you look at it, it doesn't make sense. What do you say, Shashwath?
Agreed. And there's this important concept known as reversion to the mean, where if something is being battered and you believe that it has no reason to be battered as much as it is being battered, then you should definitely consider buying into it during its tough time. So when the tides do turn for it and fate does choose to be a little more lenient towards it, you can cash in on some bonanza returns out of it. And this is basically the idea known as value investing. You basically pick rough, uncut gems which haven't been noticed or haven't been picked up by the market as of yet, or the market believes that this company is completely out of favor and it's not going to do so well. But you think otherwise, and you think that, okay, this company has no debt, it has good profit margins, it's a stable business which has been in a certain market and giving you good returns, and this business isn't going away anywhere in the next 10 years, but the PE ratio is maybe 12. But you have no idea why it's 12. First, peer through the annual report, figure out if there's something which is making this company be valued at 12. Because a lot of times, if it's too good to be true, it may actually be too good to be true. However, a lot of the times, the market does make a mistake. It doesn't understand or realize that it has undervalued a certain asset, and then it's time for you to quickly swoop in and pick up these assets before the market comes back to its senses and wants to pay a fair value or above fair value for these assets. So that is the premise of the article I co-authored, and we take some case studies in that. Basically, 4 companies is what we look at. We look at Asian Paints because it is currently being touted as one of the big, good quality, moat-oriented companies. Second company we look at is Gillette. Gillette India, again, another big company, I agree that it has a huge moat. However, with the Dollar Shave Club, and so Ratan Tata's manager who runs Bombay Shaving Company, again, that's another company which is trying to cut into this market. But let's for a second here agree that Gillette has a huge moat. For devil's advocate, let's play devil's advocate. Let's assume that Gillette has the biggest market share, and it does. And let's say the market share isn't eroding. Great. And then the other 2 companies, the companies which were battered, were ITC, which is a company which we've talked about numerous amounts of times. And the second company is Excite. Excite is a company which we haven't covered much, but it is one of those rough, uncut gems which were trading at a good valuation during the COVID period and post-COVID for a bit. So let's look at these companies. Let's see whether this idea of pay any price for good quality or buy companies with a decent quality but great PE ratio. Let's look at the case study now. Okay. So I want you to take a wild guess about what Asian Paints PE ratio was in 2021.
I don't know, 50?
Wilder.
55?
Wilder. Like much wilder.
Okay, 70?
Wilder.
90?
I'll give it to you. It's 119.
Wow.
That was the PE ratio which Asian Paints commanded in 2021, if you guys can believe it. And I really don't see what that company is offering, which is commanding a PE ratio of 119 times its earnings. I mean, what's going on over there? Over the past 3 years, the PE ratio has come down to 62, which is about like half of your valuation has come down, like a 50%. But the price didn't go down during this period. The company just grew into its valuation, as people say, it grew into it.
Yeah, because people keep forgetting that PE ratio is actually a ratio of 2 numbers.
Yeah, so the denominator can grow.
They just assume the one in the top will keep, fluctuating. The bottom really doesn't. And then it's crazy.
Yeah.
And I was telling Case of this today morning that a lot of people see Anand's old videos. And they're like, Anand said the market was going to come down to correct. It has to correct to 12,000, the Nifty. And now the market is at 20, past 20, and Anand is so wrong. I'm like, yes, but the reason why Anand said is always based on the PE.
Yeah.
Historically, Indian market has been near 20, the median. And we've been sitting above 20 for such a long period of time.
Yeah.
It has to come because an average is always bottom and top.
Yeah.
Combined together gives you an average.
Yeah.
So if you've been lopsided on the top for some time, for such a long time, it is only logical
that you have a reversion to the mean.
Yeah, because that's just law of nature.
Yes.
And it has to happen.
The pendulum always swings back.
Yeah, and when it does, it's going to be brutal because you will have to have a very long extended period of time where it will be sitting below, where you'll have a generation of people, probably at your generation or younger, who will be thinking the market, like how Japan.
Yeah.
There are people in Japan right now, stock market and broking companies don't have brokers.
Yeah.
They're trying to rush around and recruit guys, and there's nobody to recruit. They're recruiting people in their 80s and 90s because those are the only guys who knew how to sell this kind of market. You read that news, it's hilarious. Meaning, that's the same problem, like what you're saying. People don't realize.
Yeah.
I don't know how to drive this in any other fact, and it's really nuts.
Basic mathematics, but it's something which blindsides all of us.
Yeah.
And it's something you have to be careful about. But okay.
I told Kesar, the example I gave Kesar was mileage. I said it's like buying a beautiful car, but it has terrible mileage. You're burning cash just to move that car around. Why would you do that? You'd rather buy a car that gives you better mileage. I don't know.
Agreed. And it's actually quite interesting. And the price didn't expand much. And its earnings expanded enough for it to come down to 62 in its PE ratio. So everyone's rejoicing. So all of you are like, so what's wrong? Like, what's the big deal then?
Correct.
Well, this is the catch. The catch is that because the price hasn't appreciated, you haven't been able to cash in on any of the returns.
Correct.
Because for you to cash in on this return, you need the PE ratio to be at 119 and the price to appreciate accordingly.
Correct.
But your price hasn't moved. So you have this company which is trading at 119 PE, and its growth rate is 15%, which is decent. And but this company's stock price has only grown 5% over year on year over 3 years.
Correct.
That's lesser than your FD rate.
Correct.
And this is the kind of returns which growth only matters. This is the kind of returns which you're seeing with that sort of mentality.
Good evening. My team has decided to do another event. The last event was at Trivandrum, was a very successful one. So we decided to ask people where we wanted to do an event, and my team chose to do an event in Dubai. We are planning to do an event in Dubai on the 24th of February. The event is roughly scheduled between 3:30 to 5:30. It's a Saturday, you will have plenty of time. Those desirous of attending the event or meeting me may contact my team at the WhatsApp number given below or drop an email at the email ID given. My team will contact you and help you. I hope to meet you all in Dubai. It's not only Dubai, anywhere from the Emirates. I hope to see you there. Thank you. It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.